Okay, so let's move on to the next risk. Tax risk. Tax risk is, especially if you have a hedge, what you're hedging and what you're using to hedge are taxed very differently. So you might have a stock portfolio that you're trying to hedge with options, and your stock portfolio is taxed one way and the options are taxed another way. So in that case, your before tax hedge might be perfect, but after tax you might still have large losses. And where do these differences come in? Well, the differences can come in the timing, which is the most difficult one. When do you have to recognize a gain? When do you have to recognize a loss? Tax law is often written such that gains are taxed immediately and losses have to be deferred. And that can be really irritating to a strategy. And we'll talk a little bit about wash sales here in a little bit and what I faced at USAA. The character can be different. We have different tax rates for regular income versus capital gains, and that can be a big difference. Right now it's not as big of a difference as it has been because of the 2017 tax law change. Tax rates are much closer together, but there have been times in our history where you're talking about 40% versus 15%. Make a big difference if your underlying portfolio is taxed at 40%, but your hedge is taxed at 15%, or vice versa. You may be paying 40% on your gain, but only getting 15% on your deductions. Yeah, that's your after-tax hedge will not equal your before-tax. And then sourcing is important. Whether the income is U.S. or non-U.S., we've seen that with some of the big tech companies like Alphabet or Apple and Google, who can't pay dividends with their cash flow because their cash flow is stuck overseas, and so they actually have to borrow money to pay dividends. So the tax code can be quite critical to a decision you're making. You're trying to maximize after-tax things. You're not trying to maximize before tax, and you're trying to hedge after tax, and you're not trying to hedge before tax. So let me just walk through the scenario I had at USAA. So at USAA, as I showed you in a previous video, we had a stock portfolio, but we hedged it. So the stock portfolio had large losses, but the option portfolio had huge gains, and the two offset each other. So if you think about that, let me just type it out here. So your portfolio has large losses, and your options have large gains. So you say for tax is simple. We'll offset the option gains with the portfolio losses. Well, not so fast. So you only get the portfolio losses only deductible when you sell the portfolio. Paper losses are not tax deductible. So then you say, okay, solution. We'll just sell the portfolio, generate losses, and then buy it back. But this is called a wash sale. The IRS says any securities that you sell for a loss, you cannot buy them back in a certain period of time. I think it's 90 days, but don't quote me on that. The tax law haven't been around in a while. You can easily look it up and see what the wash sale rules are. So you might Google that. Be an important thing to know if you're doing a strategy where you're using options. In fact, in your own personal portfolio, you better make sure you understand what these rules are. So wash sale prevents taking losses on securities bought back too quickly. So what that means, let's think about it, 2008. So we have these large losses on the portfolio, but they're not taxable. We can't take tax deductions for them because we haven't sold the portfolio. You have large losses on gains, we have to pay those gains immediately. The IRS does not allow us to defer those based on when the portfolio has losses. Losses are realized. We can't just sell the portfolio to generate those losses so we can offset them against the option gains, because then we have the wash sales. And if you have a wash sale, the IRS does not allow those losses. You have to defer them into the future. So the things I tried, and this is what my other solution was. What if I sell the portfolio and buy back a portfolio that's 50% growth and 50% value? It's not the same portfolio. Let's say I sell a portfolio, made the portfolio as an S&P 500 index, and I replace that with 50% growth, 50% value. So I buy two index funds that are 50-50. My lawyer, my tax attorney or tax analyst said, you can't do that. The IRS would look at it. It really says the IRS will ask under oath exactly why you did the transaction. So you have to honestly say. So my thought was, well, what if we go back and we say, you know what, we think value stocks are really cheap right now, so we're going to do 40% growth and 60% value. He was very uncomfortable with that as well. There was almost no solution where we could sell the portfolio, generate losses to offset all those option gains. So it just does not work. You cannot do this. Now, fortunately, or I guess unfortunately, but in 2008, we had so many losses coming from all over the place. We had plenty of losses to offset the option gains, even without having to sell the portfolio. So it worked out okay. So it's very frustrating. You need to make sure. And what I really loved about the tax analysts we had at USAA, they were exceptional. USAA has a really, or at least when I was there, an exceptional tax department. I knew the head of the department very well. Still very good friends with her now, even though she's retired as well. I just always loved working with that department. Took their jobs very seriously. And what that analyst did for me is he came back with a 16-page report where he ran through several extreme scenarios, exactly what I was talking about. Run through extreme scenarios and see what it means. And what we finally came up with is there is no obvious solution. Let's just get back together October, get back together November, December. Let's look at what we have, see what we can do, and do our best to do something that meets the requirements of the law, of the tax law, doesn't put any of us at legal risk, but at the same time helps mitigate some of this. Some of this seems almost unfair because you bought these options specifically to offset the losses from the portfolio. You would think that the IRS would allow you to line those two things up, but they don't. And it's not because they really hated the transaction USAA was doing. What they hated was people were doing option transactions that were bogus in order to create tax losses. Tax losses. Yeah. And so when IRS shuts down an illegitimate practice, they also tend to shut down legitimate practices. Now, on the other side of this, let's say you have portfolio gains and option losses. In this case, unlike the other case, on the option gains, the IRS says those are taxed immediately and you can't offset them with portfolio losses. Here, your portfolio gains are not taxable because they're deferred, so that's good. But the IRS requires these losses to be deferred until you sell the portfolio. And again, it's just set up. IRS is set up to make whatever you do as bad as possible. So they recognize gains as fast as possible, the deferred losses. You have to go through these scenarios. It is quite frustrating. So anyway, just thinking through those scenarios, that the best solution we could come up with is let's just talk near the end of the year, see what we can do. How do you measure this? Again, it's go through the extremes. It's scenario analysis. The tax area since I was so fortunate to have really, really good tax analysts, they loved their jobs. They did a very good job of assessing. They understood exactly what I meant. This particular gentleman I worked with, I think his name was Kevin, he knew exactly what I meant by running scenarios, and he did exactly what I needed. I was not happy with his answer, but it wasn't his fault. It was the tax law's fault. How do you mitigate this? Again, you work closely with the tax department as early as possible. You can go to the IRS and get a ruling in advance if there's any uncertainty. The problem with doing that is you somewhat have played out your hand and showed them exactly what you're doing. And then if you get a negative ruling, you have that problem. But maybe if you get a negative ruling, at least you know that before you do this major transaction. IRS rulings, some of them are permanent, that they're reliable. Sometimes their opinions are just what they think right now. And then when you do the transaction, they may change their mind. So even that's not all that helpful. We've seen some large audit firms have trouble with the law. I see people going to jail because they got too aggressive in interpreting the tax code. So this is not something to play around with, to take lightly. This is pretty serious stuff. But do ask the question. One thing I had in my huge advantage on the pension plan is any derivatives transaction like the interest rate swaps I did in the pension plan. Pension plans are not taxable. The taxes on pension plans don't happen until they distribute the money to their beneficiaries, and the beneficiaries pay tax. So the pension plan did not pay any tax. I could do whatever I wanted to. I really loved that. The accounting was favorable. The tax treatment was non-existent, so I could do whatever I wanted to. It made life so much easier. Right, so there's tax risk. There's a lot there that you need to think about. The next one is operational risk, and there's a lot we can do here. We'll probably break this up into a couple of sessions. So this is your procedures. Your procedures, your policies, your ongoing operations. It's just the way you run your business. It can come from all different areas. It can be bad internal controls, and so you're exposed to theft, or rogue traders, or some kind of system failure. You have hiring risk. There's a lot of risk in the hiring process where if you don't do things exactly right, people can sue you and say, hey, you didn't hire me because of my nationality or because of my religion or whatever. The human resources people are very careful about exactly what you can and cannot say in an interview. It really frustrated me in my career at UTSA. I really wanted to be involved in college recruiting, but they really limited me on what I could ask, and I like to ask off-the-cuff, off-the-wall questions, and it made them nervous that if you ask this candidate this question, but you don't ask this other candidate this question, and somehow they're talking to each other and they find that out, they can come back and sue and say, hey, we weren't treated equally. You didn't ask me those questions because of my gender or because of my height or because of my hair color or whatever. Reputational risk, headline risk, that's a big one. We'll talk a little bit about that when we talk about one of the cases. The lawsuits, obviously, the tobacco industry has been facing many lawsuits over its history. Operational risk, earthquakes, hurricanes, just kind of natural disasters. COVID-19 definitely falls into that category right now. There's a big debate. We're talking about this in my property casualty insurance class, where most companies have what they call business disruption insurance. So that their business, they can't do their business because they can't get into their buildings or whatever. This provides you insurance that makes up for the difference in what your actual revenues are and what they would have been without that risk. Well, that insurance specifically says pandemics are not covered. And yet right now many states are coming in and are thinking about requiring insurance companies to cover COVID-19 because of the incredible hit. They're saying at least do it for smaller businesses. So it'll be interesting to see how that comes out. But you do need insurance against those type of risks. And there's a lot more. I'm going to talk some more about the reputational side here and probably in the next session. How do you measure it? Extremely difficult. One thing you can do is look at incident reports, and I like that. That's what I do in my bike riding. Someone was asking me earlier, do I do this stuff in my own personal life? And I can tell you what, with my bike riding is dangerous. There are certain places where it's more dangerous than others, where drivers are just not cautious. You have close calls. Every time I have a close call on my bike, I think about the situation and see if that close call was something related to the environment I was in. And I have several times changed my route on my bike because of a close call and thinking this road is just too dangerous. My current ride, boy, I've got it so that I think it's as lowest risk I can possibly get it, riding through certain parking lots and avoiding certain streets and certain lights. So incident reports is one way to do it. Close calls, anything you can find that wow, that could have been a big loss and I was lucky. How can I make sure that close call doesn't happen, because next time it might not be a close call. So you got to be real careful. Process is the most important, because all you do is look at the past performance. We're talking about extremely low frequency events, and so the fact that something's never happened doesn't mean the risk isn't there. So the process is more important. You've got to think through an extreme scenario. What would happen? So right now we're in the middle of a pandemic. What does that mean for your business? We've been talking about pandemics for quite some time. How many businesses actually walk through? What happens if 70% of our workforce cannot come to campus? Obviously, a lot of businesses have been working with work from home type of schemes, so we certainly have gotten better at it, but were they really prepared? Did they really think through the entire thing? You know, HEB right now, they're actually hiring more people, but their own employees are exposed to the virus. What risk are they taking? What are their employees taking? What are they doing to try to help their employees? You know, we're starting to see how good of a job firms have done with risk management when we see this reaction to the COVID-19. So how do you mitigate it? Good, well-constructed procedures that are constantly monitored and tested. This is my approach. You might think this is silly, but when I was in finance, USAA allowed me to do option transactions, swap transactions, and they put almost no, in fact, really no kind of surveillance on me, no procedures, no policies. They essentially said, do whatever you want to. It's like, oh, it's Ron Sweet, he won't do anything evil, and that was not a good risk process. So I would step back and think, how could I destroy this company with these trades? And then I personally set up procedures so that it would be impossible for me to do one of those trades. And I was real strict about it. I remember one time I did an option trade, and the compliance department didn't send out their report. And I called the poor guy. I kind of chewed him out, but it's like, where's your report? And he says, I'm too busy to do it today. And I said, you got to do that. This is an important frontline report. You've got to make sure, you know, if you don't do the report, you need to at least make sure that the transaction was authorized. This is extremely important. You know, who knows if I'm having a bad day? Someone, you know, I had a lot of interaction with the CEO. Maybe he said something that just made me really mad, and I thought, I'm going to take this whole company down before I retire. Who knows? I would have never done that, but that shouldn't be USA's control procedure, is to say we just trust this guy to do what's right. You've got to make sure you understand what's going on in your company. It's important to over-communicate to management. We're going to talk about that in the MG case. You can see how that was a huge issue for them. And make sure you include extreme scenarios. I learned that very, very frequently at USAA, is when I got something approved, I wanted to make sure management knows, hey, if this happens, this is what the result is going to be. This is how this transaction will probably look. And sometimes you have to do it multiple times, because they forget what you said last quarter, and remind them in meetings that, hey, if interest rates do this, or if the stock market does this, this is what this is going to look like. To whom do you communicate? Top management, to the board, to the auditors, some cases to the investors, some cases to regulators. At USAA, we're very open with the rating agencies. We did not want them to get any surprises. So when they called, when there was a major hurricane or some other major event, stock market crashing, whatever, we told them exactly what was going on, because we wanted that relationship strong. Yes, it's true. If we told them what was going on, they could have downgraded us, but they were going to find that out anyway. And our argument was, if they're going to find it out anyway, we want to make sure we're completely above board, full transparency with them. because if we have any issues of trust with them, they're going to downgrade us just because they don't trust us. So down here below, an accounting perspective on the internal controls. I got this from Washington University, but it's fairly generic. You've seen this before. It's important to understand this, especially if you're thinking about starting your own business, to understand the type of internal controls that reduce frequency or reduce severity. So preventative is you're trying to keep something from happening. Detective is there's something that's happened, you want to catch it early enough so the loss is small enough. There's a good book I recommend reading called Rogue Trader, R-O-G-U-E Trader, about Nick Leeson, and I think there's a movie about it as well, talking about really bad procedures at this particular bank. So internal controls, there's authorization. That was the big control at UTSA when I was a portfolio manager. They made me sign all my trade tickets to make sure the trade was authorized. You have documentation, so everything's documented. You have a paper trail. Reconciliation, that was a big part of my job as an accountant, but making sure everything can be reconciled. In the Nick Leeson case, there was an auditor who audited him, who all that auditor had to do was call the bank and see if a $300 million cash account actually existed. If he had done that, he would have uncovered Nick Leeson's bad trades and could have shut the whole thing down real early in the process. Security, you want to make sure assets are secured, records are secured, that you know where the assets are, who has authority over them. Physical security, technical security, whether it's physical asset or it's online. Obviously, cybersecurity is a big issue now. Separation of duties can be a tough one. Some of the stuff we do in finance is so specialized, so complex. There just are not many people who knows what's going on. Sometimes you actually have to hire another person just so you do have backup, just so you can separate duties. With smaller entities, I've dealt with some smaller entities, and we've had a tough time. There's one with the church and school I've dealt with. They had a policy where with the bank, the signature card with the bank was any two church members could sign on a check. And so our bookkeeper was a church member, her husband was a church member, and she did the reconciliation of our checking account. I told her we got to have separation of duties. Unfortunately, she didn't view that as that I was somehow questioning her ethics. She liked that. She did not want to be in a situation where something goes wrong and she's the first person people are questioning. She wanted it. So we changed our signature card so that she could not sign checks. She could issue checks. Someone else had to sign a check so that when she did the bank recon, that duty was separated. What I want to do with next session is I want to talk about this Glenn Holton article. I don't need you to read it. I want you to focus on the project. So I'll walk you through a summary of the article. You can get it after the class is over, and it's a very good article. And then I want to talk a little bit more about operational risk in light of what's going on in the world in the last few years. So that there's some issues I think firms need to do a better job of think through, and I think you and your career want to think through it as well. So we'll stop it there, and next session we'll finish up the operational risk.